At Lesniewski Consulting Group, we are committed to helping our clients and partners discover new opportunities and possibilities with retirement planning. LMC Group is a full-service actuarial firm with offices in Calgary, Winnipeg, and Toronto. The team consists of 4 fully qualified actuaries and a 5-person administration team with over 70 years of combined experience. At LMC Group, earning your trust is our priority. Today, I will walk you through the retirement compensation arrangement, or an RCA. With the increase in personal tax rates across Canada, RCAs are coming back to the forefront in tax planning. The RCA is a non-registered arrangement that is able to catch other benefits which cannot be funded under tax-sheltered vehicles. The contributions are tax deductible to the corporation and the assets are creditor-proof. The RCA is a federally approved arrangement which is not governed by pension regulations, thus allowing for significantly large corporate contributions. Similar to an IPP, a corporation, T4 income, are requirements for the RCA. The retirement compensation arrangement consists of 2 accounts, the refundable tax account and the investment account. 50% of the permitted contribution is deposited into the investment account, where it is invested by your investment advisor, while 50% is deposited into the refundable tax account with the Canada Revenue Agency. The assets in the refundable tax account are non-invested and are essentially loaned to the government. Each year, a tax return is completed to determine the realized and unrealized gains and losses experienced in the investment account. If the tax return reveals a gain, 50% of the gain must be paid to the refundable tax account. If the investment account experiences any losses, 50% of that loss is refunded from the refundable tax account to the investment account. Distributions from the retirement compensation arrangement are taxed to the beneficiary of the RCA at his or her personal tax rate. For every $2 paid from the investment account, 1 is refunded from the refundable tax account. In theory, the refundable tax account and the investment account should be equal. An ideal candidate for an RCA is a high-income earner who has received a minimum of $500,000 as T4 salary for at least 1 year. Let's take a look at 3 scenarios when implementing an RCA makes a lot of sense. Successful business owner or professional. If you or your client receives T4 income of a minimum of $500,000 from a professional corporation or an incorporated company, an IPP should be considered with an RCA stacked on top. The purpose is the RCA takes advantage of additional funding which could not be contributed to the IPP. The advantage of the strategy is the contribution to the RCA and IPP is deductible to the company, and assets are removed out of the corporation, which will result in reduced corporate taxes. Executive of a corporation. If you or your client is an executive of an incorporated company who has earned a minimum of $500,000 in at least 1 year, an RCA may be of benefit to you. The executive may be taking a substantial amount of earnings into income and paying taxes at the highest personal tax rate. An RCA could be implemented and a portion of the annual salary redirected into the RCA. The advantage of this strategy is once distribution commences from the RCA, it is anticipated the former executive will be subject to a lower tax bracket during his retirement and taxed on the distribution accordingly. An even better scenario is if that same executive decides to retire in another country which has a favorable tax treaty with Canada. In some countries, such as the United States, the distributions can be taxed at a rate as low as 50% if payments are spread out over a number of years, like a pension. The advantage is thousands of dollars being saved. Professional athlete. Most of the professional athletes in Canada are non-Canadians with the intention of retiring back to their home countries. Again, assuming those home countries have a favorable tax treaty with Canada, an RCA can equate to thousands of dollars in tax savings for the athlete. The organization redirects a portion of the annual salary into an RCA for the athlete. 50% is paid to the investment account and 50% is paid to the refundable tax account. The athlete retires and moves home, As in the previous example, the distribution will be taxed as low as 15% if it is paid out as a pension. There are many advantages for implementing an RCA. It is not for everyone, but when it is implemented in the right circumstances, it can provide significant benefits to the RCA member. Contact Lesniewski Consulting Group for further information.